Hi, I'm Niël Pretorius. I'm the Chief Executive Officer of DRDGOLD. It's a gold producer in South Africa, listed on the Johannesburg Stock Exchange. It's been listed for the last 129 years, and it's also listed on the New York Stock Exchange.
Yeah, good to have you in London.
Thank you. It's nice to be here.
Yeah, you've been at a conference though, haven't you?
I have, yes. I attended the Mining Journal conference.
Good one? Good people?
Yeah, good people, good platform. I had the opportunity to spend some time in the presence of Rick Rule, which I relished. It was a good opportunity. Royalty, absolutely.
He rarely comes to these shores, but it's good. Yeah, in fact, he's taking a great interest in sort of media now. He's sort of seeing the power of it. It's quite, and he's got a great little thing going on there. Anyway, this isn't about Rick, it's about you guys. We haven't spoken since like February last year. It's been a while. A lot of water under the bridge. You've been sort of hard at it, but talk to me about market conditions for you. Has it affected the way that you do business?
Well, the gold price has been really good, and it's especially in rand terms. You know, when the gold price is high in dollar terms and the rand is slightly on the weak side, we produce in rand and we sell in dollars. So that really helps. That helps the margin, especially considering where we are at the moment. We're at a time where we are really transitioning from, let's call it the old Ergo, the one that was launched in 2008. That life of mine, that 190 million odd tons that had been mined out, and was very good to us. And we're now at a place where we've assembled some of the existing resources. We brought that into circuit. That's paying for, let's call it the recapitalization of the next phase for Ergo. And we're hoping to add about another 15 odd years to the life of Ergo.
Right.
And it's really all hands on deck to try and achieve that. At the same time, you'll remember that we acquired the Far West Gold operations from Sibanye-Stillwater. That's going along really nicely. But that too is being capitalized. We're building a really large tailings storage facility. And the idea being to double the throughput at Far West Gold. So it's going to be a busy few years and a time of transition for us. Yeah. But we've got a really good platform of producing assets that can fund and deliver into the capacity of the company.
Right. So as a producer, life is good. As with all producers at the moment, they're getting an extra $200-300 of free cash. It seems this year. So we'll deal with Ergo and Far West in a second. I want to maybe remind people of the type of miner that you are. You mine in the sunshine, right?
We do,
so maybe explain it from basics, and then we'll go.
Sure. So, I mean, I deliberately mentioned the fact that next year we will have been on the Johannesburg Stock Exchange for 130 years, and the idea being to maybe just remind people that gold mining has been happening in the Witwatersrand now for more than a century and a bit. So there are huge amounts of mine waste scattered along the entire landscape. And we've managed to set up a business, a model with infrastructure and access and so forth to mine those old mine dumps. And the idea being to reclaim it from where it is, to process it, and then to deposit it onto another tailings storage facility, which is being managed in accordance with modern standards, to contemporary standards, and then restore the land where the old tailings were. And remember, Johannesburg developed around the mining industry, around the gold mining industry. So where there was farmland, it became mine land, and then it became a city. So we're mining these dumps out from right where people live, from where they play, and large tracts of land. Better part of 2,000 hectares have been cleared in that way up until now. So it's tailings reclamation, gold from tailings.
Right. Okay. So it's all about being efficient, because these tailings have obviously had gold extracted from them already, and you're trying to get after what has been left behind. What sort of grades are we talking about?
So typically it's about 0.32, 0.35 gram a ton. Right. So you got to, and then of that we recover between 50 and 60%.
Yeah.
So typically you would recover about 200 parts per billion. That's sort of the equation. Now, if you imagine what 2 million tons, because that's what we process per month, 2 million tons of material, what that would look like if you loaded that onto a train, and then you look at the production output, which is between 400 and 430 kilos of gold per month. You could stack this on the corner of this table, coming out of a train probably from here all the way to Scotland.
Right, so let's, you talked about the kind of landscape around Joburg where, literally a century plus of mining. So tailings and dumps there, as far as the eye can see, it could be argued. You're focused on obviously two things at the moment, and you're trying to use your technology to process all of that in as efficient way as possible.
Yeah.
Ergo kind of coming to the end of its current, Ergo 1 is coming to the end of its life of mine, as it were. Ergo 2, what's the expectation or hope for that in terms of the size and the scale of the opportunity in front of you using your current technology?
So when we launched Ergo initially, the life of mine, I think, was 9 years or so. And it was centered around 2 large clusters, which had been mined out. We added some additional resources. So it's an ongoing process of bringing in either converting resources into reserves because of a different climate, or because you get access to a new dump, because these dumps are quite literally scattered over an area of 60 kilometers, if not more. So that's been depleted, but we've managed to add on. But we had to take a very deliberate decision a while back as to do we stay true to the idea or the strategy of optimizing our resource, mining as much of our resource as we possibly can. And we had to put a number of things in place in order to do that. One, we needed to make sure that we have enough reliable, affordable electricity. And in order to do that, we built a really large solar plant. We built a 60 megawatt solar plant, and that's going to be combined with a 185 megawatt battery storage system.
So where are you with that at the moment?
The solar plant's done. It's 130,000 panels that have been installed, and it's systematically been introduced into the system. And from next year onward,
the system being your own ecosystem.
So there's no,
it's going into the grid at all.
There's no independent grid. Right. There's no independent grid metering between our solar farm and the Ergo plant,
right,
or the solar farm and the Brakpan Tailings storage facility. So that's direct supply. What we have done, though, is we have linked it up with the Eskom grid, and once the battery storage is in place, surplus power will start going into the grid. It's a process called wheeling, which basically means that what you put in here, you can pull off the grid at a relatively modest charge somewhere else. So it's electricity supply into a very large percentage of our electricity needs. We had to do that because the point that you made earlier about efficiencies, we're trying to maintain or we're monitoring margin on a per ton basis. So you want to really push that margin as far as you possibly can. Getting it to 60 cents, 70 cents, not cents, rands rather, 50 rand, 60 rand, 70 rand per ton, depending on where the resource is. And here you're looking at a facility that not only de-risks the business because you now have access to reliable supply. As long as the sun's out there, there's power, but it's also it reduces that per ton cost quite significantly. Anything between 9, maybe 12 rand a ton. We're sort of running the numbers, but we'll know exactly what they are. So these things are facilitating the extension of the Ergo life of mine, or the new life of mine, one that more or less resembles the TRS that was filed.
We should talk about that at length. Yeah. I think.
And then also adding additional storage capacity. So we've got to build or recommission an old storage facility right next to Brakpan at 300 million tons of storage facility, and that will then give us the capacity to further extend the Ergo life of mine and get into that new phase.
Okay. This is a conversation I think we could go on for hours, because I really enjoy the granular detail of trying to eke out percentages with all the kind of moving parts in it. Just finishing off on the energy thing. So in terms of the energy storage capacity that you're going for and the technology that you're going for, you need to do that because Eskom has been less than reliable. Load shedding is very common in South Africa. You need the certainty around that.
Absolutely.
It's worth the capital expenditure.
Absolutely. Look, it's something that we'd been looking for the better part of 5 years before we finally launched the project. And finally, I think the technology in terms of reliability, in terms of output, and also in terms of cost, it reached the stage where you could model it. Financially, it just made sense. So we basically have, I'm told not to say this, but I love saying it, we've got 3 billion rands worth of prepaid power that we'll be using over the next 20 years. The battery storage is also helping us not only to fully take advantage of all of the electrons that we're getting from the sun, but these are going to be charged. We're staying on the Eskom grid, and these are going to be charged also from Eskom, but at a different time. So we have different periods. We've got peak periods, and then we've got cheap power. Our peak tariff is 3 times higher than normal tariff. So if you're going to be charging your batteries off the Eskom grid, you're going to be doing it during off-peak, and you'll be discharging those batteries during peak. In fact, the financial model for the battery system works independently of a solar farm. You could basically, and then look, Eskom's going to change that, they have to, but you could really justify the capex to build the battery storage system on the basis of charging it during off-peak and discharging during peak, and that price difference was going to pay the capex over a relatively short period of time.
And I probably need to say this for people kind of listening in, and maybe new people to this story, is like, you guys have been paying dividends for the last 17 years. You continue to deliver gold. You know what you're doing. The process is clear and getting incrementally better all the time. So I'm not going to have a conversation with you, can you mine? You can. There's no problem. And do you pay dividends of roughly, what's the average?
Between 3 and 5%.
3 and 5%. So there's a dividend paying company. I guess what I want to work towards is trying to understand how you drive that share price response. I think you had a really good response at the beginning of 2023.
Yeah.
Right? Off the back of some good numbers there. What are the things that affect the company's performance level, i.e. what you're judged by, what your multiples are, what your PNAV looks like? Because I'm now judging you on a basis of, if I'm a generalist fund manager, I'm looking at like, okay, what's your PE ratio? What is that PNAV thing? Do they deliver quarter after quarter? Can I rely on these guys to do their thing? And that's a very different sort of conversation that most people have pre-revenue.
Yeah.
Right? So we're way past that. So these efficiencies are important. What are the things that you're discovering? So you talk about sort of using sort of new technology. You get finer and finer returns from the extraction process. So what are the options you've got on the table to make things better?
We've been talking about, let's call it I don't know if you can call it the macro dynamics, but the sort of the dynamics that we're currently experiencing in terms of share price performance. So you would have seen a really good share price performance up until the latter part of 2023. So this time last year, I think our share price was probably about 20% higher than what it is now. And if you compared that to the likes of a Harmony and Pan African, for example, which are our peers in South Africa, they substantially outperformed us this year. You got to ask the question why? Because we had the same gold price, and I think what probably impacted market perception of the company were 2, maybe 3 things. The one is the transition out of the, let's call it the old Ergo resources, into the new sites that we had to launch in order to have this platform to fund the next phase for Ergo. We met with certain setbacks and delays in that regard. And I think you and I spoke about the delays with regards to the water usage license, the delays with regards to community interferences and so forth. So we had created certain expectations with regards to output, and we didn't meet those. And we had certain delays, and they weren't easy dynamics to deal with. But they've been dealt with, and hopefully that platform is now firmly established to take us into the next 2 to 3 years. So that's the one thing. The second thing is we are going to be spending the better part, and we've already spent 3 billion of that in terms of the solar farm.
We're talking round here, folks.
Rand, yeah. So we're going to be spending the better part of probably a current share price or current market cap, close to 70% of our market cap on new capital infrastructure over the next few years, and up until 2028, 2029. That is now for these.
Is that funded out of cash flow, or are you going to need to go to market?
It is funded out of cash flow. Remember, we had a cash pile, fairly substantial cash pile that's gone into the solar farm. So the model at the moment is sufficiently robust at current gold price to fund that out of cash flows, but we obviously are putting measures in place. We are putting structures in place if we have to dip into that. Because remember, you don't pay, if you're going to be spending the better part of another 7 billion rand in capex over the next 3-4 years, you're not spending that evenly over that period of time. So towards But at the end of next financial year, there's a big number coming through.
Absolutely.
So you do need some cover.
Some kind of buffer and or hedge or whatever you choose to do.
We're not hedging.
I know, whatever you choose to do.
But we do have a facility.
What I would need to believe is that, okay, one, is that a cash flow? That's great. Is it going to affect my dividend or your dividend payment? Do you think?
So this is how we think about that. Obviously, we're not going to borrow money to pay a dividend. But if we are generating free cash, we will borrow project funding and apply free cash towards a dividend. So the mere fact that we might have some debt at a particular point in time that's been drawn down in order to fund capex at a particular point. And I made the point that you don't spend it evenly over 5 years.
Right.
You're going to have peak capex at certain
For
points.
sure.
If we had drawn down on a facility at that point in time, but cash flows were robust, we were on target and margins were good and the gold price was still steady, then at that, we would definitely want to pay a dividend then. But we're not going to borrow money to pay a dividend.
You'd be surprised how many people do. So that's why I ask. The other thing I need to believe is, I need to think about this in a way which says this is the most sensible allocation of capital and use of time, right? So if my dividends are protected, great. If I should look at this like, Ergo 2 is effectively a smarter way of doing, rather than going out and doing M&A and buying some expensive project, all of the upside is given away to the other shareholders. I'm going to reinvest our money into a project which we control, which we understand, and is literally part 2 of a sequence of assets that we can get after. So how do you use
so to replicate the infrastructure that you need in order to access and mine these new resources that are being converted into reserves, the new dumps that we bought, in order to, if you had to go and build that infrastructure, then those businesses won't work. So because essentially your infrastructure capex, your plant capex is around zero.
Yeah.
The only capex is linking it up. Sometimes it's linking it up with the pipeline, and it's extending the size of the tailings dam. Suddenly, these relatively modest, I wouldn't call them mediocre, but they're not prime assets. You wouldn't build a plant to mine the assets that we're going to be mining now, but we have a plant.
Yeah.
So because your capex threshold is so much lower, these suddenly look quite attractive, and you can mine them. And keeping in mind also that we're focusing on 2 distinct sites. So on the one hand, there's Ergo and the extension of life there, but there's also Far West Gold where we're doubling throughput also over the same period of time. So it's how you balance the mix and always working towards that point of optimizing our resource, mining as much of our resources as we possibly can, and creating value at multiple levels. Yeah,
and I guess it's that arbitrage between trying to get the allocation of capital between both assets, which will, look to come on at the same time. 27, 28, are we talking about?
We're around about early financial 28. So
right, okay. So coming on at the same time, but like I say, you want to be able to pay your dividends. You can choose at what pace you're going to move forward, with the proviso that you need to show that the ounces are coming out at a reasonable rate, because it's that balance between I can spend the money quickly, I might need to borrow, and I might need to use that facility, but that's okay because the ounces produced will hit the targets that we think we need to perform at, right?
It is not it's a robust model, and we've had it scrutinized from every conceivable angle, and as I say, the funding, the cover, the debt cover that we put in place, that is for the event that we either do not meet production targets, or that the gold price reduces.
Yeah, so, I mean, gold prices does heavy lifting for you and all producers this year for sure. It's a nice thing, a long way to continue and grow. Should we talk? Like I said, when danger, we could go on about this because I just love the engineering aspect of this. But let's talk about something which I think is hot at the moment. So, tailings. Some people kind of conflate tailings with heap leach pads, and also, and I know they're different things. But the point is, when something goes wrong, it goes really wrong. Where I'm looking at a reference Victoria Gold recently with their heap leach, which is not tailings or dumps, but it has the same connotations in terms of how you manage these big, large physical bodies of ore And you've got to do that in a responsible way. And I think that the Church of England and, for instance, said to you, right, we need to be sure, the pension fund I'm talking about, we need to be sure that the companies that we invest in do things properly. You've responded to that with a document. You're kind of clear about, maybe explain to people some of the things you need to be conscious of and manage.
Certainly. And remember, we're also a member of the World Gold Council.
Yeah.
So when you become a member of the World Gold Council, then by implication, you also commit to the standards that they promote. Yeah. So we take that very seriously. Look, the reason why we feel serious about mining as much of our resources as we can is many of the mine dumps in South Africa were built in areas where ideally they shouldn't have been built, either because it's an environmentally sensitive area, or they've become an inconvenience because a city has grown around these. So we're quite keen to, one, restore the environment in areas where dumps were built in environmentally sensitive areas. Yep. And that's not uncommon because, you want in the very first dumps, if I can digress for a second, the very first dumps that were built 130 years ago, these carts, these hoppers were still pulled by donkeys, or by mules rather. So you would fill your mine waste, you would fill the hopper, and the donkey would walk downhill to go and dump the material, and with the empty cart back up again to go and collect the next one. It's called Witwatersrand. Witwatersrand, basically, it means, it's Afrikaans for White Waters Ridge. So it's basically one big wetland. And all of those wetlands have become contaminated and as a consequence, or compromised. And a lot of the dumps that we've actually removed out of those wetlands, and they're systematically being restored. There's also a lot of land being put back into sustainable land use. What appeals to me, though, almost more nowadays, is the fact that we don't create new waste. Every single ounce of gold that we produce from existing waste. So we're a waste-neutral entity, producer. Most of the water that we use, 95% of the water that we use, is grey or industrial water. It's recycled water, all of which stays within circuit. It's a closed circuit. The only water that leaves our circuit is when it is through evaporation, but everything else goes back into the circuit. Now we're at a point where close to half of our electricity needs are going to come off solar farm, and we're setting ourselves targets. And then it's at this stage more of a ambition than a clear goal, but we want to get to as close to carbon neutral by 2030, and the opportunity is going to be there. So it's not just the risk of having access to secure supply of electricity, but it's also what is your impact. So to not develop these sites and to not mine out the rest or reclaim the rest of those tailings dams. The Far West, for example, most of those tailings dams were built over dolomites. So there's an aquifer there that the quality of which has been compromised because of where those dams are. The new RTSF that we're building, 900 hectares, 800 million tons rather of capacity, is capable of receiving all of the tailings in that entire area. So in 20 years from now, there really isn't a reason why there shouldn't be a single tailings dam over a dolomitic aquifer. They could all have been moved. And we're there. We're open for business with the surrounding mines as well. So it's something that you've got to do, not only because it makes money, not only because it offers a solid return on the capital that's invested, not only because the share price is steeply geared to movements in the gold price, and if you're an astute investor, you can make money on either side. Not only because we are both compliant with or subject to the compliance regime of Johannesburg and the New York Stock Exchange, the SEC. So the governance aspect is sorted. If you comply, you comply. But also because ultimately that area will be better. The environmental legacy that mining has left there will have been reversed and will have been restored. It's worth doing it.
No, it reminds me of the phrase my father used to use with me, which was leave the place better than you found it.
Oh, absolutely.
And you're definitely doing that. So in terms of the type of investors that you attract as a result, because I think whatever an anti-mining kind of narrative might suggest in terms of their views of mining for whatever metals around the world, this is something that is cleaning up what has gone before. So I guess you get some brownie points for that. But how does that actually translate into selling shares to big institutional investors?
So we haven't raised capital for quite some time now, for many years, and it's still not a share for fundamentalists. I mean, there's certain people who are just in principle, they're just dead set against the production of metal or a production of anything that comes out of the earth. What we do, though, and I think the new generation, the one that is genuinely concerned with the future of the planet and genuinely concerned with the environment, in a way that reasonable, balanced people are. I think for them, we take away a lot of the tension in investing in a gold stock, because we don't dig new holes, we fill existing holes. So in as much as looking at a mining site and thinking, I can make money out of that, but that's not really who I am. For that investor, here's an opportunity to take advantage of commodity cycles, to have the benefit of the dividend flow, but at the same time also knowing that the company that's producing these financial returns and that's offering this investment opportunity is reversing the impacts of the environmental legacy of mining, as opposed to adding to it. And make no mistake, I'm not saying that this is something we're superior to some of the other companies that are out there. There are primary miners that are incredibly environmentally conscious. The mindset of miners over the last few years has changed fundamentally. The standards that mining companies are delivering into nowadays are surpassing the legal compliance standards. If you look at the self-imposed standards that you'll find in the codes that they're being designed by ICMM and by the World Gold Council, the JSDM, etc., those codes are aimed at restoring ecosystems to improve biodiversity. That is many levels past the duty of care standard of managing the impact or containing the impact of your operations on the environment. So the industry is already there. And our model developed because that's what we had. That was the kind of resource that we had. But it resonates well because it delivers into that narrative. It factually facilitates the narrative of almost a circular type economy and producing a product, which I believe is a very, it's the only real currency, but doing it in a way that doesn't add to the environmental footprint. In fact, that reverses it.
Yeah, and doing good. Doing good.
I also steer clear of that. Churches and NGOs and so forth, they do good. We're a business, but we're a business with a good outcome,
right?
With a justifiable outcome, one that I think we can be justifiably proud of.
Right. Okay. Well, look, continue to do what you do. We will.
Thank you.
Stay in touch. You need to come on more regularly, because I think this is a really good story about a really well-run company with with a very good narrative and some very good outcomes. And for those people who don't like the thought of leveling mountains, this is a good way to invest in the space where you kind of restore land tracts to what they perhaps once were, and I think with pretty good outcomes. So thanks very much for your time.
Thank you. It's always very nice to chat to you.